Sustainable finance, in very simple terms, is investing money in ways that benefit both the people and the planet. Sustainable finance looks beyond the simple numbers of risk and return. Sustainable finance looks at the impact of investment. Does this investment have a negative impact on the environment or social or governance aspects? ESG factors are what actually differentiates sustainable finance from the regular finance. Sustainable finance is important for various reasons. It helps to tackle pressing environmental challenges such as pollution, biodiversity loss, climate change. Sustainable finance considers social factors such as human rights, health and safety, inequality, diversity, and inclusivity. CMA published a policy guidance note on green bonds in 2019. Econ Holdings has issued a green bond to build climate resilient student houses, and Kenya Mortgage Refinance Company issued a social bond to support affordable housing agenda. In 2021, CMA approved the publication of the Nairobi Securities Exchange ESG guidance manual to guide listed companies on their reporting and compliance obligations when it comes to ESG aspects. Under the Code of Corporate Governance, the boards of listed companies are required to integrate ESG aspects in their business operations. At the same time, take into consideration ESG aspects in their decision-making process. The Stewardship Code requires institutional investors, in our case, these are actually asset owners and fund managers, to take action and engage listed companies in ensuring that ESG aspects are integrated and they are considered in their business operations. The CMA has been encouraging issuers to adopt integrated reporting using globally acceptable integrated reporting standards, such as the International Integrated Reporting Council and the Global Reporting Initiative, among others. So these are some of the initiatives that the authority has deliberately undertaken to develop and to grow sustainable finance in the capital market sector. The global sustainable finance market was valued at $3 trillion US dollars in 2021. And this is projected to reach 22 trillion US dollars in 2031. In this regard, several listed companies in Kenya are taking ESG very, very seriously. And they are undertaking various initiatives to promote sustainable practices. For example, we've seen several companies investing heavily in clean technology, renewable energy, water management, and some of them are adopting sustainable practices on their procurement practices. Some companies are adopting sustainable supply chain practices, such as sourcing materials from sustainable sources. Additionally, institutional investors, in this case the asset owners and fund managers, are also taking ESG considerations very, very seriously. Most issuers are now issuing standalone sustainability reports detailing their journey on ESG integration and reporting. While the Capital Markets Authority has taken significant steps to promote the development of sustainable finance in the capital market sector, there are opportunities that can be explored. We are talking about, for example, the faith-based sustainable finance opportunities around Islamic funds, for example. And then in the last, from 2016 to date, we've seen a rise in the number of millionaires, significant rise. And if we can be able to tap all this opportunity to invest in sustainable finance oriented projects or investments, it will be a very, very significant development in our market. There is a clear opportunity on the carbon credit markets. In this regard, the CMA is developing a carbon trading policy framework to guide on the operationalization of the carbon credit market in order to promote the integration of ESG aspects in the market. The Capital Markets Authority is onboarding artificial intelligence and machine learning technology that has the capability and capacity to consolidate unstructured ESG information and translate the same into actionable ESG insights for decision making.